start off with the different types of trading entities that are available to South Africans today. You have an individual or sole proprietor. That's just a person who starts off on their own. They can hook up with other people and form a partnership. Or you can found a trust. Or you can incorporate a company. Let's have a look at the different advantages and disadvantages of each. Start off with an individual or a sole proprietor. The advantages are you simply get going. There's nothing to stop you starting to trade tomorrow. No formalities have to be observed. You've got full control over your destiny. There's no separate finances to be maintained, and there can be tax advantages. The disadvantages are, however, relating to risk. If you go insolvent and you can't pay your debts, you will lose everything because you have no limitation of liability. There's no continuity of your business if you die, and there is limited access to capital markets when trying to raise additional funds. Certain tax disadvantages can also arise if you make too much. There are the South African tax tables for individual taxpayers. It's advantageous to earn below 235,000 Rand and trade in your own name. You see that the tax rate can't exceed 25%. In the middle, between 235,000 and 455,000, the maximum tax rate is 35%, and that's starting to hurt. And when we go to super tax level, we see that the individual tax profile is not advantageous at all because the tax rate is far higher than companies, going up to 38% and then 40%. There is also the sixth schedule to the Income Tax Act that allows you to pay tax on a basis of turnover. If your turnover is less than R1 million a year, it's very good for micro businesses, not necessarily for all businesses. Individuals can be extended in concept to take in partnerships. What happens when you form a partnership? Well, the advantage is it should be simple, although some partnership agreements do get quite complicated. You share profits and losses amongst partners, you have greater access to funds in public markets, and you are taxed in your individual capacity on your share of profits. The disadvantages are that you become responsible for the acts of all your other partners, and you become liable jointly and severally for all the debts of your partnership. There is no continuity, again, because when you die or the partner leaves, then the partnership comes to an end. And it may not be the best way to go if you make more than 235,000 rands per annum. Next up comes the trust. Some people love trusts, I personally don't. The reason is that when a trust is taxed, it is taxed at a flat rate of tax of 40%, and its CGT rate is 20%. We see that the company's tax on revenue income is 28%, that's below a trust, and the individual's capital gains tax rate is 10%, that's also below a trust. I don't favor trusts, but on top of that there are other problems. Yes, a trust can save you estate duty in the long term. It may also protect your assets from creditors. It's obscure that it may be more tax efficient. The disadvantages are that you have to register a trustee. That can be complicated. Then we have to have trustees who have to obey certain procedures, otherwise they can be held liable for the acts and debts of a trust. We also have to look at the fiduciary responsibility of trustees. It's no simple matter. They can't do what they want. And we have to watch out for the flat rate of tax on trusts. So, thus far we've looked at individuals, partnerships, and trusts. Now we get to the incorporation of companies. Why do we incorporate companies? Number one advantage. We get the separate legal entity being created, and this leads to a limitation of liability unless the shareholders have signed and guaranteed the debts of the company. This gives greater access to capital markets, and it gives continuity. If a shareholder dies, the company continues to exist. The flat rate of tax attributable to companies is also very attractive. The disadvantages of companies runs into the administration. There are great big registration formalities. We have to comply with the Companies Act. There are regulations and monitoring processes, and there are onerous responsibilities on the directors of a company. But when it comes to tax, it's quite nice. The top rate of tax, or the flat rate of tax for companies, is 28%, much better than the 40% attributable at the top rate of tax for individuals or the flat rate of tax for trusts. And the CGT rate for companies is 22%. It's the highest of all on CGT rate, but that must be read against what happens to an effective rate of tax on revenue income, which is why you form a company. There are different types of companies. There are closed companies, or what we in the old days used to call private companies, and there are also open companies. Companies have huge requirements. You have to register a notice of incorporation and a memorandum of incorporation. There's ring fencing. You have to register a name. There are rules and shareholders' agreements, and all shares have to have no par value these days. We have to appoint directors. We have to submit annual returns. We have to prepare annual financial statements and then observe solvency and liquidity. There is no doubt about it that companies are more complicated than trading in your own name or even in a partnership or trust. But the flat rate of tax is very advantageous. In further modules, we will be going into the Companies Act and looking at the requirements of maintaining a company in the new South Africa today.